Welcome, everyone. I'm the founder of Quidroom, the social platform for where accredited investors and investment professionals come together. Before we kickstart, for all the investors who are listening in to the session and the podcast, if any of your questions are unanswered or you just want to have a chat about investing, feel free to reach out to hundreds of investment experts globally by joining their communities now live in Quidroom. To attend future similar sessions, you can join hundreds of other investors in my personal Quidroom community. The community handle is posted in the comments here. Now, let's get on with today's topic. Blockchain is all over the news, even in traditional media now, thanks to Terra Blockchain. Also, during the past few months, mainstream media has covered a lot more about the energy consumption and its impact on the environment, especially for Bitcoin, right? So today what we have is one of our Quidroom users and community owners, Dan, who is currently the Chief Investment Officer of Modular Blockchain Fund, with whom we are going to discuss further on how we can critically assess the sustainability factors of blockchain-based smart contract platforms and tokens powering them. Dan, how are you today?
Hey, Praveen, thank you for having me. And I'm really excited to have this conversation. Also see whether there's some questions from the community so that it becomes a little bit more interactive. So yeah, thank you for having me again.
Absolutely. So you have done a lot of research on blockchain and you're passionate about the potential of smart contracts. It's an interesting choice, the switch from being a senior level executive in banks to becoming an academic and a strong proponent of this industry. So even before we start with the questions, tell me a bit more about what made you leave your banking job and get on with this journey.
So I guess 3 stages. I had spent about 15 years in investment banking technology. And even though I always loved being very close to markets, as the companies that I worked for got bigger and bigger, I realized there's a lot of, I don't know what to call it, probably politics that I thought I didn't want to focus on in the future. So in 2014, I left and I started a company called Liebau Capital to basically do research and advisory work around the topic of innovation and finance. And did that for quite a while. And then obviously 2016, the blockchain topic fell into my lap. And then from then onwards, I started researching it a lot. My PhD also is focused on this particular topic. And then since, sometime early last year, I collaborated with Modular Asset Management to basically think more about an investment strategy that takes sustainability characteristics of these assets into consideration when thinking about how to assemble the portfolio. And then since February, I'm pretty much very busy with Modular and joined them as the CIO for a new fund.
Okay. I think I can guess exactly what is keeping you up every night, but it's always better that you tell me what does keep you up.
Yeah, what does keep me up? I mean, last week was pretty eventful, you can imagine.
Yes.
Collapse of one of the biggest ecosystems that had been built in the blockchain space. These are the kind of things that we are trying to avoid, right, in our portfolio. So our investment strategy is very different from perhaps what you've seen in other cryptocurrency funds. Basically, I like to distinguish them into 3 buckets. The first bucket that is very prominent in the land of cryptocurrencies is a VC fund. So it's basically a spray and pray type of approach where people try to get into the interesting projects very, very early. And then, some of the portfolio holdings will make it very big, and it's very similar to traditional VC. Most of them may not succeed. And I think the second type of investor is really the hedge fund type investor. So these guys are basically focusing on market inefficiencies of this arguably very nascent market and try to achieve some sort of absolute return. And then I think what we're going to see more and more as institutional adoption grows is basically the more fundamental type approach to investing in cryptocurrency tokens. And our strategy basically has the objective to give institutional investors the exposure to the asset class, and at the same time outperform on a risk-adjusted basis through a lot of the fundamental research activity that we're driving forward.
That is interesting. So how does the fundamental type of investing differ from hedge fund investing and the VC investing that is being done in the space at this point in time?
I mean, hedge fund investing is very much focused on absolute returns, and whether the product that's being traded is, a commodity or FX or cryptocurrencies, it's basically strategies that are trying to take advantage of market dislocations. Versus for us, we are trying, it's more like a stock picking type of approach, if you like, right? We do a lot of fundamental analysis of these smart contract platforms, or layer ones, as people call them, to basically understand what is very sustainable and will stick around for the longest time. We think that blockchain and sustainability are very big themes in investments going forward. And unlike perhaps in traditional markets, these two gel very well together, actually. That's perhaps not yet commonly understood. But if you think about what makes a blockchain platform sustainable, it's basically a lot of factors that will also help the token price in the medium term.
Absolutely. And that brings me to the topic today, because you had mentioned that we should focus a bit more about the ESG aspect of things when it comes to this sector, and that brings me to the question, because you have, from what I understand, created a model on how to analyze where each of these assets stand and kind of rate it. I am not sure whether you want to call it formally rated or informally. I would leave you to confirm that and let me know exactly how that helps. And of course, I want to also make it. I want to understand if something of the sort of what happened with Terra blockchain could have been detected through this model.
Yeah. I'll come back to Terra in a second, because it's obviously a fascinating case study, and I was glued to the screens over the last week, as you can imagine. But let's start a little bit with trying to understand how perhaps this whole sustainability topic differs to traditional markets. And so traditional markets, you basically look at companies mostly, right? And companies are structured in the same way all over the world. They have shareholders, they have a board, they have an executive committee, then they have people who basically work in the company. And it's quite hierarchical in that sense. And eventually all of the decisions that are being made around ESG or sustainability are very much executive management type of decisions, right? Which then have to be approved by shareholders. But then in these blockchain systems, it's a completely different world, right? Because you don't have an executive committee. You don't even have a for-profit company very often. You have a foundation, and then token holders are basically the members of this club, for no better word. So when we assess the sustainability characteristics for blockchains, we have to think about very different things. And we like to kind of split these into three buckets. One is the technology. One is the mechanism design, and the third one is the community. And because these buckets are so different from how ESG is being looked at in the traditional world, we can also come to very, very different conclusions. And I'll talk a little bit more, I'm sure, before we hang up, about how we go about individual characteristics of these platforms. But when you think about this Terra example, but first of all, we did not add Terra Luna to our portfolio. So according to our model, it didn't really fit. And I think that, protected, if you were invested in our strategy, it would have protected you from quite a bit of downside. Of course, there's correlations that are high and so on, but you don't have any direct exposure if you were invested in our portfolio. Yeah? And the main reason why we didn't add it is because we really focus on these smart contract level platforms. And we always felt that this the addition of a stablecoin aspect to such a layer one platform wasn't quite the right thing to do. You know? And we were not happy with how this mechanism design actually was put together, and therefore it didn't really pass our filters. So could it have been detected? Well, yes, we think that there was a heightened risk there, which is why we didn't get it in the first place.
Interesting. And I'm just going to ask one of the questions that an investor had requested around this, because it will be related a
Sure.
bit. It would be really interesting to quantify the ESG impact, say, in equivalent terms to energy consumption or carbon credits or something, to really see the impact. People often talk about Bitcoin mining energy consumption, but not for blockchain in general.
Yeah. So it's an interesting point, right? I think there was a Senate hearing recently where Ari Yields, a Cornell professor, was asked to explain to the senators a little bit more in detail about this whole energy consumption aspect. And the one thing that he kind of, how he summarized his whole talk quite nicely is he said, blockchain is not Bitcoin. And I thought that was, worth remembering. So I think the question is a little bit in the same camp. But just if I'm wrong with my assumption, it's not in this camp, I want to say a few more things about the question. So, of course, there is a big debate about the energy consumption of blockchains like Bitcoin or Ethereum even, and their proof of work mechanism, and how that compares to other industries. Some people say, well, the energy consumption of the financial services industry is also extremely high. So why are we not doing things there better and all that? And I think in my mind, there's opportunity to improve everywhere when it comes to, reducing CO2 emissions. But I don't like personally this whole whataboutism, right? It's like, I've been caught out on something. Then what about everyone else? Like, no, that's not the right approach, right? So in blockchain world, we basically have a coordination problem that we're trying to solve. And that is, how do you reach agreement across these different technology nodes on the content of the ledger, right? And then there are different approaches on how to achieve that. The very prominent consensus mechanism is called proof of work. Yes, requires a lot of, is very energy intensive. And then there's also other alternatives, for example, proof of stake. And there's already research by quite reputable academics that if configured correctly, proof of stake mechanism actually gets you to a reasonable level of security and consensus, but using lots and lots less of energy. So we're talking millions of times fold. And I don't know. I feel like when people talk about green energy and using it for powering a blockchain, sometimes I think that is a little bit like, you have a glass in your hand and then you think, you drop it and then somebody tells you, I'm very good at putting the glass back together. Like, well, why don't you not drop the glass, right? And that's kind of the difference in my mind, at least for smart contract platforms specifically, which is what we're interested in. Bitcoin may have other uses as well. That's how we try to assess this E component in ESG. What I would also say is that this has kind of been talked about for a lot now. So there are lots more interesting aspects to look at in the S and the G compartment as well, which I believe are a little bit undervalued and also not very well understood or priced in, for that matter, in the markets.
Absolutely. And I'm very curious to know about the S and G factors that you specifically consider your model that go outside of the E before you make the decision.
Yeah. So, I mean, under the social bucket, right? Let's take one example that I thought was interesting. I don't know whether you saw that a few weeks ago, a company called Yuga Labs tried to mint non-fungible tokens that represent land in a metaverse that they're creating. So the demand was huge. And then eventually to process these transactions, these sale transactions on the Ethereum blockchain cost up to $10,000 per piece. Wow. Up to $10,000 per piece. Imagine. I mean, that's like Yeah, that's like if you're buying a ticket to a Madonna concert and then you get an invoice, and then the Swift cost or the cost to wire the money to Madonna is, $5,000 for a $200 ticket. I mean, it makes no sense. Yeah. So what we look at in social is, how can this platform actually really be adopted and be used by many, many, many more users than these platforms are being used to today? Huh? And then we think that there are issues with, the cost of the transactions. But our analysis is quite comprehensive, I would say. So we also try to understand the roadmaps and the strategies about what type of applications are being built on these platforms, right? And that's also another key input for us to then feed into the model and eventually come up with a reasonable weight. Okay. On the governance side, I don't know whether I should quickly talk about the governance side. I think governance side is also interesting. There's another recent example, the Ronin blockchain. You might have heard about it in the context of Axie Infinity. One of the things we look at is how many validators are there on these platforms, right? And if they can basically dial into a Zoom call, then we think there's probably too few. In this particular case, I think there were under 10. And then if I remember correctly, 4 out of them were run by the same company. So you basically have only 6. So that means they can either collude or they can basically be hacked very, very easily. So looking at how many validators there are and if they are run by same or affiliated entities is another data point out of the many that we look at to assess the sort of governance maturity. There are many other governance characteristics as well, but this is a good one because it's tied to a recent case. So if we pay attention to these things, then we could have avoided a number of issues that we have recently seen in the markets, which is kind of where we are coming from.
That's an interesting point, Dan, because it is going to be, it's eventual. There's definitely going to be more inflow coming in from Instas, right? So the way in which ESG is perceived, just like how you mentioned before, is very different when it comes to digital assets. It's not going to be the same because the operational model is also very different.
Correct.
And that brings me to another question that an investor asked, which is a bit more generic on the ESG side of things.
Okay.
How do you counter the arguments that ESG is still practically a theoretical concept, while when it comes to investing, a lot of Instas are still not considering ESG impacts of the companies? Fundamentally, is it a wrong debate to have purely when we are thinking about investing in returns?
So, one thing that I can say after reading most of the ESG papers that look at traditional markets, at least the ones that get published in top tier journals, there's no consensus about the ultimate framework, right? And there's also no consensus whether ESG is net contributing to excess returns or whether it is a cost. In fact, now we're trending towards it's a cost. So that's kind of interesting to think about. So if you're in traditional markets, you basically have to make a choice. Do I want to push for ESG and accept that maybe my returns are going to be a little bit lower than if I didn't pay attention? Right? This is probably amplified massively right now with the conflict and all sorts of commodity shortages and so on, right? Oil and so on. So that's in the traditional markets. I posit that in the crypto markets, it's actually the other way around. So many of the characteristics that we believe contribute to making a platform a sustainable platform, as the word suggests, actually, sustainability means, you're going to be around for a long time, help us pick those platforms who are eventually going to be the winners. And then, people can say, well, but how do you prove that? So we have a collaboration with another Cornell professor where we are investigating that in a research program to understand which of the characteristics actually can empirically be associated with excess returns. And while we're doing that, it's kind of interesting because you can't really assume that you find something that is statistically significant in past data if the market doesn't really appreciate it, right? So I'm fully comfortable if we find no significant results for some of the characteristics that we're looking at now, because I know that correlations between different cryptocurrency assets is very, very high. But that in turn also means there's quite a good time to look at a strategy like ours a little bit more closely, because if something is not very well understood in the market, that's where there's also opportunity. So that's how I think about it.
Absolutely. You have made a very strong case of exactly how even ESG factors should not be considered the same, and the impact should not be considered the same as traditional markets. And you're absolutely right. We are skewing more towards ESG being considered more as of an expense rather than something that is going to be adding on to returns in the traditional industry. I'm bringing another question by another investor in here. I read a post around how Bitcoin's use of the blockchain technology is not very efficient, and ultimately it will be replaced by better, more energy efficient crypto coin. What is your take on this? To a good extent, you have already covered this, so whatever extra.
Maybe I'll just add. In our strategy, we very much focus on these smart contract platforms, and we think about them as operating systems for people to conduct commerce peer-to-peer, right? Yeah. It's almost like like the Microsoft Windows versus Mac OS or something like that, right? But for distributed commerce. So for these platforms, we already have evidence, theoretical, also empirical evidence, that there are alternatives to the consensus mechanism that is used by Bitcoin. And there are already a number of platforms out there that operate on that level. And they, as I mentioned earlier, they use, fractions of energy. So that's kind of good. Bitcoin in itself is not really aiming to be a smart contract platform, is aiming to be a hard money. Maybe that's where we need that type of consensus mechanism. But I also have to disclose that I'm not exactly a specialist on that, in that field, because our focus is very much, focused on these ecosystems that develop. Yeah. Because in the end of the day, if people compare Bitcoin to gold, I want to be more on the sort of equity side of things, if you like. And I'm trying to think about growth and economic activity rather than some sort of reserve asset.
Absolutely, Dan. So as we are coming closer to the end of the session, it will be easier to understand for the investors who are going to be listening to the podcast as well, that how would they be able to work with you?
Mm-hmm. How will they be able to work with me? So this is kind of not 100% the right forum to obviously talk too much about the fund, because we need to make sure that we are all compliant and so on. But obviously, please reach out if you feel that you want to learn more about our strategy, about the products that we're launching under Modular Asset Management. And I'd be very happy to kind of share more. If you inquire, there's a whole bunch of documentation that we can obviously pass on that explains a little bit more in detail what we do. Because while I like the format of constraining our session today to 30 minutes, I also appreciated that we could probably only scratch a little bit on the surface, because there's a lot of research work that has been done that goes into how we apply these fundamental research work into compiling the portfolio.
Yeah, absolutely. And that obviously works really well for future sessions as well. So investors can gain more insights about this market, and they get to have a chat with you on a one-on-one basis or on a group basis. So that brings me to the next part. What would the investors be able to gain by joining your community room on Quidroom? What kind of insights can they gain through one-on-ones with you, or through the group forum that is there for you in there, specifically only for accredited investors and above?
Sure. I mean, I like to think that we are probably the first ones who thought about sustainability and ESG in the context of cryptocurrencies and blockchain platforms. So if that's a topic that you find interesting, then we've done a lot of thinking about how to go about this, very much beyond some sort of remediation actions like, I don't know what, buying carbon credits or something like that. I mean, that's very simple. So I think we want to be perceived as a thought leader in the space of sustainability and blockchains. So if that topic is of interest to you, then I'll talk to you all day long, or as long as I have. And that basically is our kind of value add. We want to help people understand these risk characteristics because we think that for the long-term viability of these platforms, these characteristics will become more and more important. Yeah? And there's also a kind of turbo booster to all of this, which is ESG regulation, right? Companies will now have to report on their adverse environmental impact, for example, right? And they have to do that across the supply chain. So if that's the case and you are a user of a particular blockchain platform that is very energy efficient, for example, it's going to show up in your annual report. Okay? Your investors are going to ask you, hey, why did you pick this platform? Yeah? So it's not only the investor side, but then also the user side that needs to understand these characteristics. And I think that's where there's going to be a lot of mind share. So if you are joining the room, then I'll be happy to expand more on that as well.
Absolutely, Dan. And I would personally also be looking for some of your insights, some suggestions in terms of white papers and all, because just to end on this note, there's a reason why Dan is so actively focused and so enthusiastic about this. You went into this, so it's for personally, you are very interested in the space. So there's a lot that we can all learn. So for all the listeners, please join Dan's investor community. And any questions that you have about how ESG's marriage is going to work with the whole blockchain ecosystem, I don't think that there is a better person to answer your questions than Dan. So I will leave it on that note, but that's it for now, Dan. It's really good to have you on board, and let's make investment better one step at a time.
Thanks a lot.
All right. Thanks. Bye.